All right. Well, welcome everyone to our fourth and final workshop here on with American Pacific Mortgage on Home Buyer Workshop, all things you need to know about buying your first home. My name is Josh Prim, the Assistant Vice President of Alumni Relations here at the UConn Foundation, and I'm thrilled as always to be here with another one of our virtual offerings for everyone. Tonight we're joined by Jason Mehta of American Pacific Mortgage. As you might have heard as we were getting started here, he's out in sunny California where it's about 20 degrees warmer than it is here in Connecticut tonight. But that's nothing new. If you know anything about, the Sacramento area, it's always a little bit warmer than it is here in the Hartford market. But
Yeah.
we're thrilled to be back here again, talking with Jason about all things that we need to know about getting ourselves ready to get out there on the housing market, figure out what we need to do, and hopefully find that dream home we're all looking for. So as we get started, though, I do want to make sure everybody is aware. I'm dropping this into the chat now. There is closed caption availability for you. All you need to do is go down to that bottom of that toolbar there, click that CC option, and activate your subtitles so you can take advantage of everything you need to know here. The chat and the Q&A sections are both open tonight, as always, so feel free to drop in any questions you have, any commentary you would like to see, perhaps some follow-up with. We'll do our best to continue to answer all of those throughout the evening tonight as we go. Jason is joined by his colleague Ken Fleck out there with APM as well. He'll be monitoring some questions along the way also, and I'll be here hoping to navigate if you have any technical challenges, doing the best I can from my seat to help you out in yours. But before we gotta get started, want to make sure if anybody has any things that you need to throw out there, please free to use that Q&A in that chat. We always like to hear where you're calling in from or you're dialing in from, so please go ahead, throw that into the chat. We can kind of get started. It also gives Jason a little bit of a leg up on what he needs to know about where you're
Yeah.
potentially looking at buying your home. So, Jason,
Sure.
welcome as always to the show
Thanks,
here,
man.
and we'll kind of throw things over to you.
All right. Thanks, Josh. Appreciate it. All right. Well, good evening, everyone. Thank you so much for taking some time out of your busy schedules on a Wednesday evening to join us for our fourth and final class for the year. This has been an exciting opportunity that we've really enjoyed over the course of 2025 to help educate our UConn alum on home buying. And we hopefully can impart some tools and resources on you tonight to be able to help you in making, which is probably going to be one of your biggest financial decisions in the future. So, over the course of the next 60 minutes, we want to just give you a few takeaways that you can have in pursuit of home ownership. And as Josh mentioned, I work for an organization called APM. So APM stands for American Pacific Mortgage. We're the ninth largest lender in the country. We're what he calls a direct mortgage lender. So we lend directly into our communities that we serve all across the country. And our team in particular focuses on strategic partnerships to help bring homebuyer education to our local communities. All right. Today's class is a very interactive class. So if you do have questions, as Josh mentioned, you can use the chat function. You can also drop questions in the Q&A. Myself and Ken will be kind of monitoring both of those windows. I'll answer some of your questions on air. And we are recording tonight's class. So if you want to kind of look back at some of your notes or just kind of if you missed something, yeah, step away. We'll have this all recorded for you. All right. Tonight's talking points look a little bit like this. So we're going to talk about the housing market, what's going on with it, some seasonality that's happening in the markets, but also interest rates are becoming more favorable for buyers. So that's obviously changing the dynamic in the housing market. So we're going to kind of explain to you what's going on there and some projections going forward. We also want to kind of look at renting versus buying. Does it make sense for me to go down either one of those paths? We'll talk a little bit about credit and how to prepare for home buying and maybe some low areas of opportunity, if you will, and give you some resources around credit. We'll talk about programs that are available to you as a buyer. Some of the things that you might have heard. I'll give you kind of a high level look at some of those products that are available to you as a buyer. We also want to talk a little bit about savings for home ownership. That can tend to be one of the bigger challenges for some of our buyers is, do I have enough saved up to help really achieve my goals of home ownership? And speaking of savings, we'll also take a look at some first-time homebuyer programs that are available to us in our local communities. And then the last topic that we'll kind of cover, which is probably one of the most important, is the buying process. So like, where do I go from here after attending a class? How do I get started in the process? What is it going to look like for me? So I'm going to kind of walk you through the workflow of buying a house. All right. So that's what you're going to kind of experience in tonight's class. And so again, I encourage you to ask any questions from me. We'll be more than happy to answer those on air. Our run time will take us to about the top of the hour. And of course, we'll weave in some of those answers to your questions. Well, let's go ahead and dive in, and let's kind of first of all think about the buying goal, right? And does it make sense for me? Because as I mentioned earlier, it's probably going to be one of the biggest financial decisions you decide to make. Now, buying a home is a lot different than buying a car because we got to figure out, really some of those benefits or those elements that go into buying that's going to make it a huge opportunity for us. So when we think about buying, there's opportunities to create more of a fixed expense with our housing. So we don't have to worry about maybe the monthly payment jumping up on us like we do when we rent, because maybe the landlord comes to us and says, "Hey, Jason, your rent's going from $2,500 to $2,750 next year," and having to adjust your expenses accordingly. And when you buy a home and you're now an owner, you do have the opportunity over time as interest rates decline to refinance your home and to decrease your monthly outgo. And so that's what a lot of buyers, especially that we've served over the last couple of years, are starting to consider, trying to take on a lower interest rate option in order to help improve their overall outgo with their housing. And when you own a home, this is an asset that should be able to work for you. So as your home goes up in value, as you pay down your mortgage balance, the difference between those numbers, that's called home equity. For most of us across the country, that's our number one asset, probably next to our 401ks or our retirement plan. So it really should be working for us. And as that asset grow, it really does have an opportunity to create generational wealth for families. From a tax perspective, mortgage interest can be potentially tax deductible, which can help decrease your liability in taxes on an annual basis. And when I make like improvements that are energy efficient improvements, that can also help kind of preserve what I pay as outgoing tax bill. So a lot of great things to consider when you do look at home ownership. So I always can encourage clients, like, don't look at home ownership just from the lens that you're paying $2,500 a month in rent, so it's going to have to be a $2,500 mortgage payment, because there's all of these benefits that have to be factored into owning a home. How I like to kind of position that in our conversations with clients is to look at a calculator like this. This is called our rent versus buying calculator. This is one of many calculators we have available on our website. We encourage you to kind of check these out. By the way, I didn't mention this earlier. Things like this calculator and some of the other tools you're going to get tonight, they will be a part of our slideshow that's going to get sent out to you tomorrow for signing up for our class. But I thought I would walk you through this rent versus buying calculator. I think it's a great tool to help you kind of better understand comparing renting versus owning and what it looks like. So just for time purposes in tonight's class, I thought I would just kind of pre-fill this out. And so in this scenario, we have someone that's thinking about buying a $450,000 home with a minimum down payment of 3%. And we'll kind of talk more about that in the product segment. In that type of scenario, that person's going to borrow about 97% of their purchase price. And we have kind of an average interest rate here, amortizing that loan over a 30-year term of the loan, which is generally the case for most people buying their first home. And then if we made an assumption that I was going to buy my home, let's say in December of this year, we put that into our calculator along with the cost of mortgage insurance. And we'll spend some time looking at mortgage insurance a little closer tonight. But ultimately, mortgage insurance comes into play when I put less than 20% down to purchase my home. We also want to factor in things like homeowners insurance and what my taxes are. If I'm choosing to buy a condominium, maybe a townhouse, or maybe a planned community that has dues that are owed, then I would factor that into my payment as well, right? So that would be my homeownership side of this calculator. And then I also want to look at the tax benefit, like we just kind of talked a little bit about, what tax bracket am I in? How much is it going to cost me to maintain my home on an annual basis? I'm eventually probably going to sell my home at some point in time. So I want to factor in those costs of selling it at some point in time. And ultimately, how much is my home going to appreciate from an annual perspective? Now, that obviously differs based upon the cycles of the housing market. Also, where's my property located in the United States? Some areas of the country appreciate higher than others. And then this assumes someone that's paying, say, $2,000 a month in rent. So that's going to be on the side of the renting. We also have got to factor in the cost of renter's insurance and the cost of my rent going up about 2% on an annualized basis. So what our calculator tells us, which I think is a great way to kind of start thinking about home ownership, is that if I was to buy today a $450,000 home, it's going to take me about 4 years to break even on the buy side versus continuing to go down that path of renting. Now, that break even is attributed to the appreciation of my home over the next 4 years, also the tax benefits that come along with my home, and then comparing that against my rent that's going to go up about 2% on an annualized basis. So that's where my break even's at. Now, really where it gets exciting for us as future first-time home buyers is that, if I was to span out maybe 10 years, now it gets a little bit more interesting, right? Because now after 10 years, I have about an $82,000 buy opportunity versus continuing to rent and probably paying someone else's mortgage, right? So that's where it gets more of an opportunity starts presenting itself for owners, really. And then that doesn't even take into consideration how much equity I might achieve over a 10-year span of time. So that's really the picture that we want to paint in comparing renting versus buying. And as we continue to kind of explore more about home ownership and does it make sense for me, that calculator is a great kind of launching point for you. And again, that'll be part of our slideshow that we get out to you in tomorrow's email distribution. All right, now let's pivot a little bit. Let's talk a little bit about the housing market specific to Connecticut. This is a reflection of the Connecticut housing market, but it looks very similar to other parts of the country. Just yesterday, I was teaching a class in Southern California where you can see a very similar trend of, seeing kind of rates go down, a little bit, or not rates, sorry, the home prices going on the decline a bit. And we saw actually a very similar graphic in looking at the Southern California market yesterday. And so when we look at what's happening in the market right now, we are seeing some supply starting to stack up all across the country. Connecticut is actually better than other markets. Just yesterday when I was looking at some markets in California, it was close to 60 days, average days on market. Connecticut's a little bit shorter, not as much supply. I think what we're seeing in that market is not many buyers active in the market right now. That could soon change with what we're seeing happening in interest rates. But we are seeing supply starting to stack up across the country. There's 4 states that have the highest level of inventory right now. That's Texas, that's Georgia, Colorado, and Florida. They all have the kind of their own thing going on right now. It's leading to a kind of a backlog of supply. Supply has been kind of the bigger challenges over the last 2 years in the housing market. Now, housing markets do cycle. And, as Josh mentioned, the weather's starting to get a little bit colder in the Hartford area. So we're probably going to see less buyers going out in the market as the weather starts to turn. And then as things start to warm up in maybe 2026, we'll probably start to see more buyers active in market. But that's not the case in all parts of the country. But that's the generalization. We kind of see slowdown in the fall and winter months, start to see the pickup in usually April to August. But I don't think the housing market's going to be the same this year because what we're seeing right now is interest rates are starting to decline. There's a lot of pent-up demand out there in the buyer's market. Our phones have been ringing quite a bit. Our inquiries online have really increased with just interest in what's happening in the housing market. Now, before we kind of dive into interest rates, I did see we had a question in the chat. Josh mentioned about kind of where I think Josh was mentioning about where people are located. So we had one of our audience members is joining from Monterey, so not too far from me. And so I know you have a higher median home price, and that calculator that we used, we took kind of just a national average, but you can do obviously your own calculation when you get the slides tomorrow. If you do have specific questions about your Monterey market, which I'm very familiar with, obviously feel free to shoot me a message on that. I'm more than happy to answer that for you either on session or offline. Okay. All right, let's talk a little bit about interest rates and what's going on. So as I mentioned, interest rates are starting to decline. We're starting to see more buyer activity pick up. And you may have seen in the news, the Federal Reserve cut rates about 3 weeks ago. So we got that kind of in the markets now. So that brought the anticipation of that brought mortgage interest rates lower. Now we're looking forward to the next 2 meetings by the Federal Reserve to see if they act in making another 2 rate cuts before the end of 2025. So one of the things I think it's important to understand as a buyer is that mortgage interest rates don't drop when the Federal Reserve says we're cutting interest rates. We actually already anticipate the cut of interest rates. So generally what you'll see is, Federal Reserve will make the announcement out here, but mortgage interest rates have already declined going into that announcement because we've already seen the economic indicators that are going to say, yeah, the Federal Reserve is going to cut interest rates. And so when we got the last cut, interest rates have already fallen to the low 6s. Now we're looking for that next breakthrough level of interest rates. And you can see by our chart here in the last 12 months, interest rates, you can see that's the dip we saw with the Federal Reserve announcement. And so ultimately we're trying to get some, kind of idea of what the next move is by the Federal Reserve. And so we're all watching really carefully, and I know our consumers are as well too. So when you hear the Federal Reserve say we're going to cut interest rates on that day, that will immediately drop auto financing rates, credit card rates, and probably the high yield savings accounts will see a dip as well too. But mortgage rates will kind of anticipate that reduction. So as we look forward into the market, we are going to see rates go down. It's not a question of if, it's more of a when. So we'd like to see some more relief here this year. As we move into the end of 2026, that's where we'll probably see a full, probably 1% difference in interest rates than what we're experiencing today. Over the last 25 years, you can see a look back here. Interest rates look very similar. Housing prices looked a lot different. But this chart kind of shows you some major economic challenges that we faced as a country. The most recent, is the pandemic. We can see here, we can see the housing crisis of 08, 09. I like to bring this recent economic crisis that we experienced in the pandemic to into the class, just to understand the interest rate levels, because many clients think that we're going to wait to buy a home till we get to 2.5% interest rates again. That's probably not going to happen, because we probably are now facing another crisis globally. So certainly that's not likely to happen. Everybody's looking for the lowest priced home, the lowest interest rate. That is kind of the perfect storm, but that's unlikely to happen. We obviously have to manage and see as a future buyer, like, when's the right entry point for me in the market? Do these interest rates make it affordable for me? Is the cost of housing worth it for me to jump in the housing market? And hopefully getting tools like this in our class like that will help you make a good financial decision for yourself. And we'll certainly be a partner for you as we meet with you for a consultation as well too. Now, all interest rates are not the same for all buyers. I think that's important to understand. Like, there's different characteristics that go into interest rate, things like credit score and eligibility for a specific product, what the program is that you're going to elect, how much you're financing, what your down payment looks like. You do have an option as a buyer to pay what we call as discount points, which essentially is you're paying additional funds out of pocket in order to bring down your interest rate. Usually 1% of your loan amount will equate to about a 0.25% reduction in interest rate. I was just having this conversation with a client this morning about discount points, and they said, hey, Jason, I really want to get a 5.5% rate. And we talked about that. You can certainly do that, but the break-even point for those investments are about 3 to 4 years. So I don't generally recommend doing it in today's market, but it's certainly if someone's looking to achieve a certain payment level, it's certainly we can have a conversation about and design their financing as such. Now, loan term can also, reduce your interest rate. So if you select a cheaper term of your loan, that can also help bring down your mortgage interest rate. Ultimately, when we meet with you for what we call as a home buyer consultation, it's a one-on-one virtual session. We're going to figure out what the right design looks like for you with your home financing. All right. Okay, now a question came in the chat before we talk a little bit about credit. Do you see interest rates getting below 6% in 2026 with the expected Fed cuts again? Possibly. Yeah, I mean, I think that's where everybody's waiting to see what happens. I know existing homeowners would love to see rates go below 6%, because that's going to open up a flood of refinancing. And then obviously for new home buyers, that's going to happen. It's a really kind of a TBD situation right now. I mean, that's what we're all waiting for, to see what happens. It could push rates below 6%, and that would be obviously very welcomed on our side. So we've been battling through the last 2 to 3 years of higher interest rates, and even these latest moves we've seen have been super helpful to create better affordability for our buyers. All right, now we're going to kind of change or transition into credit, and credit is one of those areas of opportunity for some of our clients, and so we like to kind of talk a little bit about credit in our sessions to give you maybe some takeaways that you can institute into your own credit profile to help you kind of maximize your credit score for eligibility on financing. And I think it's important to understand that every loan program does have a minimum credit score. You can see those up on screen. And as you know, there's 3 different credit agencies, such as Experian, Equifax, and TransUnion. Each one of those credit agencies reports a different score. And in lending, we always take the middle credit score of all 3 credit agencies reporting. So for example, if I have a 740 score as my highest score and 720 is my middle score, let's say 700 is my lowest score. When I'm qualifying for a mortgage, we're going to take the 720 score for qualifying purposes. Now, if I'm going to apply with my partner and my partner's at 700, 680, and 660, Well, the lowest middle score between the two of us is that 680 score. So that's what we would be using for qualifying purposes for the mortgage. All right. So that's kind of how we would look at it from a mortgage perspective. Now that lowest middle score influences interest rate, mortgage insurance, and the type of product that I can elect in my home financing. All right. Now, there are three different models to credit scoring. There's a mortgage model, which we're going to use when it comes to purchasing a home. There's auto financing, and there's a credit card model. Now, in most of your monitoring tools that you're probably using as a consumer, you're going to be seeing the credit card or consumer credit card model show up. So if you have Wells Fargo doing some monitoring for you in your bank account, they're sending you, hey, your credit score is 760. They're looking at a credit card score for that monitoring service that you're receiving. I would encourage you, if you're not doing some type of monitoring of your scores, you definitely want to be checking out your credit every 6 to 12 months. I know some clients check it out every day, but you definitely want to at least be looking at it twice a year, doing some kind of housekeeping on what your credit looks like. Now, when we look at events that are on our credit report, like major events like delinquent of credit, collection accounts, events that are impacting negatively our credit score, they usually will hit the score for the most recent 12 to 24 months. And then as I start getting some recovery going, as I maintain on-time payment history, then I'm probably going to start to see my credit score increase. All right. Now, this matrix here shows us how long those negative items will stay with us on our credit report. So if I have a late payment on a student loan back from October of 24, so I'm still within that 12 to 24 month range. So my scores maybe has improved slightly, but it's still going to stay on my credit report for 7 years. All right. So that's something you can use to kind of evaluate how long something will stay with you on your credit report. Now, as I mentioned to you, there are three different models to credit scoring. We're going to take now a look at the weighting for the mortgage model. So as you're preparing to take on home ownership and you want to maximize your financing, I thought I would walk you through the weighting of the mortgage score calculation, because hopefully you'll be able to identify some areas of opportunity for you with your own credit score. So let's look at the first, we'll kind of go around along this wheel here, but the first area would be length of credit. So essentially, how long have I had credit? The more mature my credit file is, probably the higher my credit score is. If I took a client's credit report, one was 6 months of credit history, one had 6 years of credit history, all things being equal, the person with 6 years of history would probably have a higher credit score than someone that has 6 months of history, because they don't have that long-standing payment history, right? Now, as we move along further, that's 20% is going to be how many new accounts am I trying to open up. So if I'm opening up a lot of new accounts, especially in the most recent 12 months, and I'm having someone do a hard inquiry on my credit, it's probably impacting my score. Now, there are rules in place that allow you to shop with as many lenders as you want, or mortgage lenders, I should say, or auto financing lenders in a 30-day window of time. And it's the equivalent of one credit inquiry hit to your score. Now, we do things a little bit differently with our team in qualifying you for your financing and help building out your plan. We actually only start with a soft credit check. The reason why we choose to do that is because many of our first-time buyers that I work with across the country, they have various time cycles on when they're going to buy, right? You might be looking to buy in 1 to 2 months. Some might be looking to buy in 1 to 2 years. But we want to be able to connect with you and provide you counsel on homeownership without impacting your score. And so that's why we always start with a soft credit check. And a soft credit check does not impact your score. It just gives us, as a lender, visibility to your score, your payment history, obviously the amount of accounts you have, and what your minimum payments are for those accounts. All right, and then this is probably the biggest area of opportunity for most of our buyers we work with, and that's around revolving credit utilization. So essentially looking at credit limits that I have available to me versus how much do I have in balances to those credit limits. And so, we may have acquired some debt that's lifting those balances up to higher percentages. And so as we evaluate options for clients, we're going to kind of identify, where should we try to get those revolving balances down to help improve that credit score. So let's say, for example, I have $10,000 in credit limits and my balances today are at $8,000. So I'm currently right now at 80% utilization of credit, which is on the high side, and it's probably detracting from my credit score. My first action item would be to try to get below 50% utilization of credit, so below $5,000. And then once I've kind of got myself adjusted to that level, try to get below 30% or $3,000. And then your optimal level, so when you're looking at like 800 plus credit scores, you probably have 10% or less utilization of credit. Now, here's a tip I'll give you to kind of manage down credit card debt, but to maximize credit score. If you look at one of your credit card statements tonight, take a look at the billing cycle or statement date. It's coined different phrases for different creditors, but ultimately it's the previous 30 days of activity on your account. So what I've charged, what I've paid, maybe adjustments on refunds, whatever, right? So my tip for you tonight is if you can pay off the balance or pay it down before the end of that closeout date, what's going to happen is you're going to be able to show a much lower balance that gets reported out to the agencies for your 30-day reporting cycle. When you do that, that's going to show you lower utilization, maximize your credit score, as long as you can get it done before the closeout of the billing cycle date. Because the cycle date, when that closes, that's when the creditor sends out the information to the 3 agencies. All right, last section, which is it's the bigger impact item, which is payment history. That's looking at how I paid my bills, especially over the last 12 to 24 months. And if you've had late payments, they're going to be rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. The higher my delinquency date, the bigger impact I'm going to have to my score. Again, especially in the most recent 12 to 24 months. All right, I gave you a lot on credit, but I want to make sure we have a good understanding of that, and hopefully there's a few takeaways you have. Now, we also look a little bit further into credit when it comes to student loans. And some of you that are attending tonight's class might have loans that are in forbearance. Some of you might be in active repayment. So I just want to kind of give you the lens that we see from the lending perspective. So if you're in active forbearance and you're looking to apply for mortgage financing today, then we do have to take a percentage of the loan balances to kind of like factor in a monthly payment. So if you're qualifying for a conventional loan and you have $75,000 in student loan debt, then you're going to use $750 as your monthly payment. If you're doing an FHA loan, then we use $375 in monthly payment to factor into your expenses versus your income. We call that debt to income ratio. You're going to learn more about that in tonight's class. But ultimately, if you're not on repayment, I just want you to understand that we do have to factor some type of payment into the calculations. Student loans are in kind of an interesting position right now. We're seeing some servicing transfers happen where different servicers are taking over student loans. Some people don't realize they're not in repayment. And so it can be a little bit of a challenge when it comes to financing. So it's good housekeeping for you as you're preparing for these conversations around homeownership to really understand where your student loans are at. Now, if you're in a savings plan right now that's income-based repayment, then let's say you have that same $75,000 in debt and you're paying $250 per month or even $15 a month, that payment can be used for qualifying purposes as long as it's in active repayment. All right. So that's really the key, is if I'm in active repayment or not. If you're in a program that you're in public forgiveness debt because you're working as a public employee, sometimes that allows you to have your debt forgiven after 10 years. Even though that'll be forgiven down the road, we still would have to count a minimum payment for qualifying purposes. All right. Okay. Again, if you have any questions as I'm kind of going through some of this content, don't hesitate to drop that into the chat or the Q&A, and I'm kind of monitoring both windows right now. We're going to go ahead and now talk a little bit about loan programs, and we're going to kind of take like a 10,000 foot view at some of these programs. And a lot of this information you've probably heard about, or the terminology, at least in some of the things that I'll share with you now. And so we'll start with the first product, which is a conventional loan. Conventional loans are Fannie Mae and Freddie Mac loans. You're seeing them in the news a little bit more now, especially with the talk about privatizing both Fannie Mae and Freddie Mac and what it could do to the housing market. Still to be determined on what that's going to look like. But right now, they're under conservatorship by the U.S. government based upon the housing crisis of 08, 09. They are starting to reduce the balance sheet of what Fannie Mae and Freddie Mac loans are on the books right now. But ultimately, Fannie and Freddie set guidelines for us as lenders that we can lend in the conventional loan space. It does have a minimum down payment of 3%. Up to the conforming loan limit, which is just getting updated right now. But the previous loan limit was 806,500 with a minimum credit score of 620. Now, I know we have one of our audience members in Monterey County, which is a high cost of living area in California. Those loan amounts can go higher, closer into the $1 million range if you're in Monterey County. But it does come with a higher minimum down payment. So instead of 3%, that would come with a 5% down payment. So that Monterey is just an example. If you're in Arlington, Virginia, that would have also a high cost of living area that you could go up to $1 million plus in loan amount, but that down payment would increase. FHA loans would be government insured loans, minimum down payment of 3.5%. The maximum loan amount will vary based upon where in the country you want to purchase. So they're county specific. It is a government insured loan by HUD. They're going to have a little bit more flexibility in the guidelines than we would see probably in a conventional loan. You can see the differences in minimum credit score requirements. Now, FHA and the loan just below that is USDA. Those are both government insured loans. Both of those products took on residency changes for eligibility about 90 days ago, maybe longer, which basically states that you do have to be a resident of the United States to access those programs. So you cannot be a non-permanent resident to access that suite of products. Unfortunately, that change was made. However, conventional loans do allow non-permanent residents to still access those financing streams. All right. FHA and USDA are both government insured. USDA is insured by USDA. That allows a buyer to purchase in more of a rural area with a no down payment option. It's based upon the location of the property, and they also look at the size of the household versus the amount of income is being generated in that household. And then the jumbo loan that's up here is not typical for first-time buyers, but it's available to us. If we need a little bit more buying power that stretches beyond, say, what Fannie Mae and Freddie Mac can offer with their loan amounts, then we could look to a jumbo loan, but it does have higher down payment options. It does have higher credit score requirements. And then finally, for our veterans that have eligibility for the VA home loan, the VA product is a fantastic tool to help the veteran with a zero down payment option, flexibility in really qualifying, whether that's expenses, credit score, and there really is no maximum loan amount for the VA home loan product. Now, these four programs in most parts of the country can be coupled with first-time buyer assistance programs. We'll talk more about first-time buyer options later on in tonight's class, but when we think about the minimum down payments for those products, you can also get resources to help supplement what you would have to pay out of pocket for some of those products. All right, now we're going to talk a little bit about mortgage insurance, and there's two kind of lanes that we're going to cover in mortgage insurance. One is PMI, which is around conventional loans. PMI stands for private mortgage insurance. And then there's MIP, or mortgage insurance premium, that gets set up with an FHA loan. Now, both insurance coverages essentially cover the lender against default by the buyer. So if someone was going through economic challenges, couldn't make their payments, then the lender would be protected against that. Now, there's various characteristics that go into these mortgage insurance options. So I want to kind of explain to you both. Let's first of all take on the conventional loan, that has PMI. PMI comes into play when we put less than 20% down to purchase a home. It does have three factors that go into the mortgage insurance calculation. It's down payment, it's amount financed, and then essentially what my credit score is. Now, mortgage insurance on the conventional side can be a little bit misleading online. You can see some wild premiums that are out there on some of the search sites like Redfin or Zillow or stuff like that. Mortgage insurance, the higher I can get my credit score, the more I can put down, can really make that mortgage insurance a really minimum amount out of pocket on a monthly basis. Now, on conventional PMI, it does have a cancellation option. So once I reach 2 years in the loan and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. So if we were to look at our same $450,000 scenario from earlier, now we're financing that amount of money, we put down 3%, and we have a credit score of, let's say, 740. The mortgage insurance is $183 a month. So, it's not inexpensive, but it's not maybe as costly as you might think in some of the other calculators that you see online. Now, if I can get my credit score up to 760, maybe 780, that would help to lessen the burden of the mortgage insurance cost. Now, on the FHA side, it's a little bit different because there's actually two forms of mortgage insurance. There's upfront mortgage insurance, which gets calculated at 1.75% of my loan amount. And then there's also monthly mortgage insurance that's 0.55% of my loan amount. And then we take that by 12 months of monthly payments. On FHA mortgage insurance, there is no cancellation option. So essentially, I'm going to have to refinance out of an FHA loan in order to cancel my mortgage insurance. We would generally look at the FHA loan as kind of that entry point to home ownership for our home buyers that really need a little bit more flexibility in qualifying. Maybe it's because of credit score, maybe it's because of expenses, maybe it's just overall past credit events that are just making it a little bit more limiting to access conventional. But certainly the FHA loan can be an opportunity for our clients. Now let's look at the same payment calculation on FHA. So we take the same amount financed to 450, but now we have to add in upfront mortgage insurance, and then we also have the monthly amount. So you can see those figures on screen here. So It is going to be more costly from an FHA perspective because it's, simply, looking at the more kind of the higher expense risk, I guess, if you will. FHA is going to have a lot more flexibility for our buyers, unquestionable, versus a conventional product. But again, it gives that entry point for buyers into home buying. All right. I had a question that came in which is, can you talk a little bit about insurance requirements when it comes to high risk climate areas? So I am not a licensed insurance agent, but I will just kind of give you the lending perspective across the country. So, obviously climate elements will impact the cost of insurance. We deal with issues in California, Texas, Florida, to name some of the states that we operate in, that we do see, obviously some extreme premiums that are out there. I would encourage buyers that as they're identifying a property that they're looking at, if they have an address, they can certainly get a quote online just to see what the estimated insurance looks like. Some states like California, for example, have premium controls called Fair Plan that allow people that are in high fire risk areas to be able to get state-backed insurance that makes it a little bit less expensive. And I think other states are doing things similarly. But yeah, I mean, insurance is one of those things that has changed quite a bit in our world. It was just always a foregone conclusion that it was going to be X premium, but insurance carriers have definitely tightened up. Some have even pulled out of certain states. So it can be a bit of a challenge at times. Hopefully that answers your question. And then I think there's a follow-up to that, which is, isn't insurance required for some loans? So homeowners insurance is required for all financing. And so you have to get homeowners insurance. It has to be active policy. We were just talking about mortgage insurance, and maybe, I don't know if those topics are getting confused, but mortgage insurance is in play for someone that's putting less than 20% down on a conventional loan and anyone that's financing with an FHA loan. And then question came in the chat, which is, if you know you will not reach 20% of the home, do you recommend putting down closer to 3% with the mortgage insurance, or put down however much you can at the time of closing, if it's only like 10%? So I think the amount of down payment really depends, right? It depends on how much liquidity I have as a buyer, where I'm trying to reach from a monthly payment perspective. And those are all conversations that I have with buyers on a daily basis, just to kind of figure out, like, what's the right design for them. Is it 3%? Does that payment work for them? Is that going to keep them in a better or healthy position from an assets perspective? Or do we really need to get to 10% and maybe liquidate a little bit more funds because they got to reach $2,500 a month or whatever the number is, right? So those are certainly conversations we have. When we work with clients, it's a customized plan. So we're going to take your financials, we're going to understand them, we're going to have conversation, and then just build a blueprint for home buying, essentially. Okay. All right. Okay, let's now turn our attention to income for qualifying. So I get a lot of questions around, hey, is my income eligible? Can this source of income qualify me for a mortgage? Have I been on the job long enough? So we're going to talk a little bit about that. Before I do, though, I did want to kind of pass along some of the documentation that's generally asked for in determining your eligibility for a mortgage. So this is generally the required documents, if you will. And through our application system, you can upload those documents. That's a really easy process as part of our kind of like administrative work for the financing. All right, so let's talk a little bit about income. And in lending, we're always going to verify or validate the last 2 years of history of employment, but that can be also inclusive of educational history. So, when we verify, a history for a client, we can look at someone that's had, let's say, 2 months on the job, but let's say they graduated from UConn in January and they just started their job, but they have 4 years of undergrad. We can put that timeline together to make up the 2 years. So oftentimes clients will come to me and think they have to have 2 years on the job, which is just not the case. We can put together educational and employment history to make up that 2-year history. So that's kind of the rules in lending. Now, there also is scenarios that we see where someone's been on the job for 6 years, but they're getting ready to start a new job and they're worrying about, is that going to impact my eligibility for financing, which is not the case. We can actually qualify clients for a job with as easy as an offer letter that's executed, and of course, understanding when they're going to start that job. So that can absolutely happen in lending. So that's kind of how we can put together employment history. Now, there are 2-year requirements around, self-employed individuals, for example. We have to see a self-employed person has filed at least 2 years of taxes to validate their income, because we'll basically do a 24-month average of that income. If I have two sources of income, I work for two different employers. In that scenario, I have to show that I've been doing both jobs simultaneously for the last 2 years. I have to make sure it's sustainable as it comes to like the lending requirements. Now, if I have variable components to my compensation, so let's say I work in tech and I have a base salary plus my organization grants me restricted shares of stock, or I have an annual bonus or a quarterly bonus, whatever the case may be, right? Those are variable sources of income. So in that case, if I want to count those towards my income qualifying, then I have to show I've been on both jobs simultaneously, or sorry, been on that job, I should say, for the last 2 years for me to count those variable sources. If I'm an hourly employee, so I work 40 hours a week, I'm making $25 an hour, but I want to count my overtime because I work 60 hours a week and I got 20 hours of overtime. I have to, in that case, show that I've been on my job 2 years to count that variable overtime source. All right. Last two things I want to touch on income is, sometimes we'll have clients that work a 40-hour work week job, but maybe drive for Uber or do DoorDash on the weekends. We can count those ancillary income sources, but we do, to my point earlier, have to show that they've been doing both the 40-hour work week job and driving for Uber or Lyft or whatever simultaneously for 2 years, okay? And then the last thing we want to touch on is other sources of income. So sometimes we'll have a situation where you have a partner that's contributing towards the household income and expenses, but for whatever reason, they do not want to be a part of the application. We can't, unfortunately, count that source of income unless they're going to be part of the application for you in your financing. All right. Now, when we look at income, we also take a look at expenses versus income. We call this calculation debt to income ratio. It does look at your pre-tax income versus your existing expenses and your projected housing expense. And so it looks a little bit like this. So your housing expense is going to include principal and interest of the new mortgage, what the property taxes look like for your respective home or projected home, homeowners insurance, maybe mortgage insurance if I'm putting that less than 20% down that we've been having conversations about. And then I factor in maybe a homeowners association dues if I'm buying a condo or a townhouse, and then my existing bills like student loans, personal loans, car loans, credit card minimum payments, all that stuff gets factored in. And then we take that and we compare that versus your pre-tax income. So if we looked at a scenario that we have on screen, this person has a $3,000 housing expense, $500 in other expenses, and then they make $10,000 a month. Right now, they're at 35% of their income being consumed by those expenses that exist and projected expenses in housing. Now, the guidelines for financing allow you to go up to as high as 45 to as high as 50%, believe it or not, which is super high. Now, most of our clients are going to be buying obviously lesser debt to income ratio. The sweet spot or comfort zone for most buyers is like 33 to 36% debt to income ratio. That's kind of where everybody feels pretty comfortable. And you can see kind of the varying degrees, but the guidelines will allow us to go to 45 to 50%. This is just a metric to determine qualifying, doesn't dictate affordability. And affordability is that conversation we're going to have as part of your consultation. Affordability might mean your debt to income ratio is like 25%, right? And so we want to, many times when I'm meeting with the client, they say, hey, Jason, I can afford $2,500 a month. That feels good to me. They may qualify for $4,500 a month. It doesn't mean that that's the right plan for them. So we're really going to kind of be laser focused on trying to hit the plan that hits for affordability for you. All right. Okay, so we're going to talk a little bit about down payment, and then we're going to transition to first-time buyer resources, and then we'll wrap up tonight's session with the workflow. So I want to kind of take you through what's going to happen after we leave tonight's class. So let's talk really quickly about savings for homeownership. That's probably one of the biggest challenge for most of our buyers. Now, before we do talk about a savings plan, I want to kind of talk to you a little bit about the various sources for savings. These are conversations that I have on a daily basis with buyers, which is essentially like, where am I going to pull my funds from for my home purchase? Now, of course, cash accounts like checking and savings accounts can be utilized. You just can't use cash immediately for home purchasing. Every asset has to be seasoned for at least 60 days. That would include things like cryptocurrencies. So like crypto is not recognized today in financing. So to use that type of resource, you would have to sell the currency, have it seasoned for 60 days in your account, then you would be able to use it for financing. We're always going to kind of source large deposits that come into the account. We got to make sure everything is kind of paper trailed accordingly. Retirement accounts can be used, 401ks, 403bs, 457 accounts. Those can be used, but I would encourage you, even including brokerage accounts, talk to your financial or tax advisor before you access those accounts. And then gift funds can also be used. That's where a family member is helping contribute to the purchase. There is no seasoning requirements for those sources, but we just have to document where those funds are coming from. Now, in preparing for home ownership, like I mentioned, savings can be a big challenge for some of our buyers. And we may be in a good spot from a monthly perspective, like to be able to afford the mortgage. But maybe in the now, we're challenged with saving up enough money for down payment and some of our closing costs to purchase my home. So I want to give you a simple approach to savings for home ownership that is a really successful recipe. In fact, one of our clients that's buying a home right now just went into escrow just the last week, I think it was, applied a very similar plan and went from having a minimal amount saved to having over $40,000 saved just by creating this discipline in their savings and being able to get that resource together for themselves. So it looks like this. So if I'm currently in a position today where I'm renting at $1,500 a month, but after meeting with us for a consultation, we think we can afford about $3,000 on a monthly basis. What I would encourage our clients to do is to start basically saving like you're making that projected mortgage payment of $3,000 today. So on the first of the month, so November 1st hits, I'm going ahead and paying that $1,500 to my landlord, but I also create the discipline that I'm gonna take another $1,500 and I'm gonna put it right over to my savings account without even thinking about it, right? So I'm now creating that discipline of paying $3,000 outgo from my payroll or my check. And I'm now at the same time growing my savings account by $1,500 on a monthly basis. So, 6 months rolls around, I have $9,000 accumulated in my account. By the end of the year, I have $18,000. And that doesn't even consider some high yield accounts that you can take advantage of too as well. So that's a great way of creating that discipline of savings, but also preparing yourself to take on a double outgoing expense, right? And so we want there to be that kind of that acclimation into home ownership and not having to be such of a stretch. And I think that's an approach that can help you with that. Now, in savings for home ownership, there's also assistance resources that can help close the gap for you with what you need to purchase your home. There's what we call as HFAs, housing finance agencies that are all across the country. So whether you're in Connecticut or Florida, or you're in the Colorado market, or even on the West Coast in California, there's HFAs or first-time buyer assistance resources that are available to you. Usually they're designed to support low to moderate income households in home ownership. In Connecticut, for example, there's the HFA that allows you to get up to $15,000 in assistance that you can take action with. There's the time to own assistance program up to $25,000. And it's forgivable at 10% per year. And there's also generally some lower rate options that come along with these programs and special programs for first responders, military, or teachers that access these programs. So there is some great resources out there for you. If you're interested in some of the first-time buyer programs, these are conversations that we're going to have as part of your consultation with us. And nationally, we offer what we call the Pathway DPA program that's going to be a little bit more inclusive in terms of it doesn't have a first-time buyer designation to it, but there's also no income limits because most of the first-time buyer programs across the country are going to have limitations to 80 to 100% of median income. Sometimes it goes up to 125 to 150% of median income. All right. And certainly, like I said, we can chat through some of those if that's of interest to you. All right, now we're going to finish up on our next topic or last topic for tonight, which is really the buying process. And I really think that's one of our most important conversations to have because, where do I go from here after attending a class like this? Hopefully you guys have had one or two takeaways that are going to help you on this path towards home ownership. But as you leave tonight's class, we would love to be able to get connected with you for a consultation. That's a one-on-one virtual session I do with every client that we work with through our classes all across the country. And so we essentially sit down on a 30-minute session and basically build a plan for you. And the output of that plan is to either one, get pre-approved and say, okay, let's go ahead and start continuing down the path. Or two is maybe we have to do some homework. Maybe we have to work on a credit plan. Maybe we have to work on a savings plan for home ownership. All those things that we have to do to get ourselves prepared to take those next steps. Well, if I'm pre-approved, that means I now have kind of the baseline for my financing, and then it allows me to move forward with the house hunting phase of the process. And for most of our buyers, it's going to start online, kind of creating a filter of homes or communities that I want to purchase in. And then as I identify homes that really fit the criteria that I'm looking for, Then I'm going to start partnering with a realtor to guide, kind of like going out and start looking at homes in my local community that I'm interested in. We always encourage you to work with a realtor in your market. We do have preferred realtors that we work with across the country that we can introduce you to as part of your home buying process. But a realtor should be an expert in the market, obviously understand what you're looking for, and be able to negotiate the proper home loan structure or home purchase structure for you. Now, once you identify the home that works for you, the realtor will help construct an offer for you. That offer will then get submitted to a seller, and it may get accepted the first time. It may take 1, 2, maybe 3 tries to get an accepted offer, multiple properties, multiple searches. Sometimes it happens the first weekend for our buyers when they go out and look at homes. Sometimes it takes multiple weeks, sometimes 2 and 3 years to find the right home. But ultimately, it's kind of at your timeline, right? Now, when you find that home and the offer gets accepted from a seller, then that's going to continue to move us down the path. Step 3 means we have an accepted offer and we're going to enter escrow with that seller. We now have a ratified contract. The day that happens, we're going to give you a call and say, hey, congratulations, your offer, we've been advised that your offer has been accepted. Let's talk a little bit about next steps, and let's get you scheduled for your follow-up virtual session with me so we can kind of talk more about the design work for you on your financing. Let's set some milestones for you in your home purchase. Now, that'll be kind of what starts the financing, and then you'll start having other action items like getting your earnest money deposited with the title or escrow company or maybe an attorney's office, depending on what state you're in. For most parts of the country, an earnest money deposit is the equivalent of 1 to 2% of your purchase price. Now, that deposit will count towards your total out-of-pocket expense, but ultimately it is going to be your initial investment into that property. Now, in most parts of the country, there's what we call as a contingency period inside of that contract. There's varying timelines that essentially protect that deposit for you to do some research on the property to ensure it's a sound investment for you. Things like getting your appraisal done, which I would help with as a lender. We'll get that order to ensure the home value is matching up to the purchase price. You're going to have inspections that your real estate person will organize for you, and you'll get your loan approved. Usually in most parts of the country, that contingency period will run anywhere from 7 days to as long as 21 to 30 days, depending on your contract period. So that will all be negotiated in your purchase contract. Now, as we go through these different milestones in the home buying process, as your lender, we're going to be sending out disclosures to you that will essentially kind of highlight everything that we've covered during that virtual session. That really happens within about 48 hours of your accepted offer back here at step 3. Now, we'll continue to move through the milestones. Like step 4 is the administrative functions of your loan, verifying your employment, your assets, your credit again, making sure the product's all designed properly, and giving you all that information as we move through the milestones. Now, one of the things I like to point out to our class is that interest rates change daily in the market. And as you're doing the home search here, interest rates might look a little bit different. Hopefully they're less than what they were at the time of pre-approval. Once we go under contract with the seller, then we're going to have a strategic conversation about how do we kind of time the market as best possible to watch interest rates to try to secure the lowest interest rate option for you. Now, I would consider us an expert on watching the market. We kind of watch the market at 6 a.m. every day till the market closes, and we're really trying to secure the lowest option for our clients to be able to kind of time the market, because economic news is changing so rapidly, which can influence either negatively or positively the interest rate market. As we continue on, we're now at step 5. We're at loan approval phase. That means the underwriter has approved your loan, and you're also now getting the final closing disclosure just after that approval, because now prior to that, you've received initial disclosures. We now probably have locked in your interest rate, so you get a redisclosure, and then you get a final closing disclosure at step 5. It also takes you probably to the end of your contingency period. And at the end of contingency, you're going to basically be communicating with your realtor on clearing or signing off on that contingency. When you do that, that tells the seller that you're now ready to move to the final stages of the process, the closing process. And that gets us to step 6. And step 6, that is one of the in-person steps in the process, let alone from finding the right home and looking at and walking your home for yourself. Everything is all done digitally in the home buying process until you get to step 6, where you're going to be signing documents in person with either an escrow officer, an attorney, or a public notary. They will review all your documents with you at that time. You'll also be wiring in your final funds at that time, which will be kind of your final closing amount. That's provided to you by the signer for your loan. Those monies get reconciled along with your loan funds. And then after all that happens, documents get recorded with the local county recorder's office. They'll record a transfer of ownership as well as a deed for the financing. And once all those deeds get confirmed, then we get a chance to get our favorite call of the day done, which is to say, hey, congratulations, high five, you did it. You're now a new homeowner. It's a huge celebration, obviously a huge, huge financial milestone for our clients, but that is really the end of the process. But our relationships with our clients don't end there. We have an aftercare program that we stay connected with our clients by, looking at options to refinance your home through our rate watch system when the time is right to be able to seize that. Because, when we look at some of our clients that bought 2 years ago, well, their interest rates are at 7.5%. So now they're looking at refinancing to drop their rates to 6.25 or lower. And so that's what we do in staying connected with our clients. Also providing you tools like HomeBot, which will track your home equity, allow you to kind of see how your home is working for you. And of course, always staying connected with our clients on an annual basis, because let's face it, things are always changing for us financially. We just want to make sure we're there as a resource for you. All right, if you're thinking about getting started in the process with us, we'd love to be able to get connected with you. I'd love to be able to meet with you for a virtual session. It does start with what we call our get started information. It is a simple online application. We only do a soft credit check, so you don't have to worry about your score being impacted. You'll upload documents, and then you use our scheduling system to either schedule a virtual session or a phone session. I think virtual is the most effective because then I can do some screen sharing with you. Of course, you'll see us on camera, make sure you know who you're working with. And, as your trusted advisor, we want to just make sure that you understand all your options in homeownership. And, we really embrace technology in our process, but it doesn't really change the human touch, because we always want to stay connected with you, whether it's call, email, text. We want to make sure we're there to help support you along in this process. But our technology, we can leverage through our mobile platform. We leverage AI and some of our tools like HomeBot, some of our calculators that we help you with. But here's our APM mobile tool. Great way of kind of following the progress of your loan. You can use the calculations in there, and you can even apply right through mobile through that technology. And as I get to the finish line in our class tonight, again, I want to thank you so much for being a part of this class today. Part of the workshops that we've presented over the course of 2025, we also pass along a discount to the UConn alum, which is $750 off of your closing costs. So whether you're going to purchase a home with us or refinance with us one day, we're going to discount our services to try to create the best and most affordable option for you in your financial resources. All right. And of course, we'd love to be able to get connected with you for one of those consultations. So with that being said, I want to kind of pass along my contact information. So if you want to get connected with me after class, feel free to do so. You can use one of those numbers here. And of course, we have our social platforms that you can check out. And we'll have this class up on our YouTube channel. And you can kind of see what our clients and, really some of our folks that have attended classes are saying about us in our local communities. We're really proud of the work we do in providing affordable home ownership, and we can hopefully help you on that path as well. All right. Josh, I got you right to the top of the hour. I did my best.
Every time, man, like clockwork.
I tried to do it.
No drink of water, nothing. You must be like a machine at this point in time, doing this all day, every day.
Yeah. Just a talking machine. That's what I am.
Well, we appreciate your time, Jason, and to Ken for the
absolutely.
support on the back end and answering all these questions, and for everybody joining us tonight. We will get an email out to you tomorrow with all the details Jason mentioned. So this recording, there's the slide deck that he went through today. You'll get that as well as a link to that unique UConn Alumni website you have there. And you can go ahead and set up all the time that you need with Jason and team to get started on your home buying adventure. So Jason, thank you again, as always.
Yeah, absolutely, Josh. Yeah, it's my pleasure.
Pleasure having you here. Thank you all for joining us tonight on this Wednesday evening. If you have any further questions, we'll make sure that gets over to you, all the contact details for Jason and team. You can also reach out directly through me, and I can make that introduction for you. But we look forward to seeing you all at the next opportunity. So thank you all for joining us. Thanks again, Jason.
All right. Have a good night, everyone. Bye.